the end of 2020, retail started to really flood into markets. As professionals, you saw that starting to happen, and you're like, oh, that's interesting.
Totally.
All right. And then January 2021 comes around, and GameStop and AMC and the others go crazy. And you're like, wait, what just happened? Was that just something fleeting, or was this a shift?
Welcome back to the Bullish Studio Podcast. I'm your host, Brian Hanley. Today we are joined by Dave Lauer, CEO of Urvin Finance and the co-founder of the retail investor-focused advocacy group, We the Investors. Dave brings a wealth of experience in the financial services industry, having worked at Citadel as a high-frequency trader and also testifying in front of Congress on numerous occasions. We the Investors is an independent advocacy group of over 200,000 retail investors, financial services professionals, and industry leaders that are fighting for change on Wall Street. They represent the interests of retail investors, you and I. They're going up against well-funded, deep-pocketed firms such as Citadel and other market makers. Please enjoy my conversation with Dave and make sure that you're subscribed to the Bullish Studio YouTube channel and that you're following us wherever you get your podcasts. Thanks and enjoy the conversation. Today with me is Dave Lauer. Dave, I'd love to give you an opportunity to introduce yourself and tell us a little bit about what you're up to.
Yeah, thanks for having me on. I'm the CEO of Urvin Finance and one of the co-founders of We the Investors. So We the Investors is a grassroots advocacy campaign focused on empowering individual investors to represent themselves and to be represented before the SEC and Congress, and focused on market structure. So, market structure is the rules and regulations that govern the stock market, how it works, and how it is set up to either help or hinder various parties that are, transacting in markets, buying and selling stock. So my background is finance mostly. I was in high frequency trading, so I wrote software that traded stocks very fast for many years. I did quantitative research and then software development. So that's really where I started my career. I worked with large asset managers. I worked with exchanges. I've worked with regulators and enforcement authorities over the years, consulting in various roles, and just trying to both help, institutional investors understand markets, help enforcement authorities and regulators to understand markets from a vantage point of someone who, it was there as electronic markets, really took off, and as high frequency trading really took off. And so, that's kind of been the last, 18 years of work that I've done.
That's great. Yeah, that's exciting. And I think just, the stock market is a big place. It's a complicated place. It's a mysterious place. And but there's been a lot of excitement over the last few years. I think, obviously COVID really kind of, stimmy checks led to a huge rush of retail investors. So I guess, can you talk a little bit about, your experience over the last few years and going from, working at the Citadels of the world to then becoming a voice for retail? Like what spurred that and why?
Yeah, no, it was a real trip because most of my experience up until 2021 was on the institutional side. It was working at hedge funds, with hedge funds, mutual funds, pension plans, like I said, exchanges and regulators. And that was the only part of the market that I really knew. I mean, of course, I'm a retail investor, and I was always buying and selling my own under my own accounts, but I didn't really have the experience of a retail investor, because when I wanted to look something up, I had all the tools that the professionals would have. I was on professional trading desks or working with them. And so when this all started in 2021, I think the end of 2020, retail started to really flood into markets. And we saw that as professionals. You saw that starting to happen, and you're like, oh, that's interesting, totally. Right? And then January 2021 comes around, and GameStop and AMC and the others go crazy, and you're like, wait, what just happened? What was that?
Yeah,
right?
Totally.
And was that just something fleeting, or was this a shift? Was it a paradigm shift in markets? And I still remember. It was something like, I think it was March of 2021, where I woke up one Monday morning. It was, after a weekend, and my phone was like unusable. It was just completely unusable. And I was like, what's happening here? And it was Twitter had like destroyed my phone from the notifications I was getting. And, I at that point, I had like 5,000 followers, and there was a community of people on Twitter that liked to argue and debate about market structure, people, experts from all around. And it was fun. And now suddenly, like, Twitter took over my phone, and I had to like go onto a computer and disable notifications. I was like, what happened? And someone in Wall Street Bets had found an interview of mine from 2013, I think, with CNN about the dangers of dark pools. And they had posted it, and then people found me, and it was really quite intense. I'd never had anything happen like that before. And so I started interacting with retail investors, mostly on Reddit. And I hadn't really used Reddit. I'd signed up for it a long time ago and never used it. And I was on Reddit and interacting on Wall Street Bets and Superstock. And what I saw was that a lot of people were really interested in markets, and they really wanted to learn. They wanted to understand how markets worked, because something didn't seem right, especially after the sneeze, the way that GameStop had spiked up like that, and they were trying to figure out what was going on. And it just happened that I know like how markets work at a very, I think, fine-grained level, and so I just started answering questions and talking to people, and then doing the Reddit AMA, and that's kind of how I found myself immersed in this world of retail, and also seeing the problems with the data that retail had access to, and being surprised actually, like these brokerage apps that were terrible, just unbelievably, even for active traders, were just terrible, because data was not a priority for brokers, because they don't make money from it. And so that's when we thought we could do a bit better with that. That's sort of where Urvin came from. And then as we worked and spoke with more people online, we saw that there was an opportunity here to change the markets, change market structure, with retail leading that effort, rather than being led and represented by their brokers and by the middlemen.
Totally. Yeah, it's been exciting. And like, obviously Wall Street Bets went from being like, a couple 100,000 people talking about YOLOing into stock options to now 10, 15 million people big. And it's like, it's more than that. Like, people are actually, want to educate themselves and really want to like, vote with their dollar, invest with their dollar, and I think that's been a really exciting trend that we've seen over the last few years. And I think what you're doing on both the advocacy side and also the data side is really exciting. So I guess, could you, let's start with We the Investors. So, can you talk a little bit about like what is We the Investors, and what started it, and where are we at now?
Yeah, I what I saw and what I have seen for many years as we sort of debated market structure, like I said, I've sort of been in this since 2012. So in 2012, I testified before the Senate Banking Committee, and that kind of was my entree into this world of market structure policy.
How was that, by the way? Like, how was the prep for that? How was that whole experience?
Terrifying. I can't even tell you how terrifying.
It's a lot of eyeballs on you.
I'm not someone who is good at public speaking. It does not. I mean, maybe I'm good at it, but it doesn't come naturally. I should say. Right. And basically, I didn't sleep the night before, all right? And I was a wreck when I got there. But generally, as usually happens with these things, even if I'm a mess right before, which I even like yesterday, I had a meeting with the SEC, with a large group of people at the SEC, and I was a wreck before. It's the same thing every single time. It doesn't get easier for me. Like, I'm a programmer. I'm used to being on a keyboard.
Totally.
But then as soon as things start, like the adrenaline hits, and I'm usually okay. And it was one of the, I mean, honestly, like one of the coolest experiences in my life. Like, you walk into the Senate, you've got senators up there. They're sometimes they're interested in what you have to say. And I testified then, and then again in 2014. And in 2014, actually, I had better understood the process, and I was more in touch with like some of the offices. Right. And so I thought that went a lot better. But it is amazing to feel like you're a part of the process and hopefully making a difference. I don't know, these things move at a glacial speed and they take a long time, but I felt good that I was doing what I could to try and change things for the better. And being sort of the only person or one of the only people involved who has no incentive. And that sort of gets back to how We the Investors formed, which was the only people in market structure that purported to represent retail investors up until this point are the brokers, the discount brokers, and the middlemen, the wholesalers. And it's kind of silly that they can claim to represent individual investors when individual investors aren't their customers, right? Like, to be a customer of someone, you have to pay them money.
Right.
And if you're trading for free, you're not paying anyone money.
You're the product.
You're the product, exactly,
yep.
right? And who pays the brokers money? It's Citadel and Virtu and the others through payment for order flow. So, like, they're the customers, and the brokers are there to represent their quarterly earnings and their annual bonuses, just like the wholesalers. And it felt like no one was really representing individual investors in an independent way. So, we thought, hey, there is an opportunity here because it's both this confluence of things, right? It's this massive interest and new technology and social media that lets you, mobilize in a way that you couldn't 10 years ago. You didn't have enough people out there. So what we saw, it was in March of 2021, and basically, Jon Stewart was doing this episode
awesome.
On markets.
All of his work around this was unbelievable.
It was so cool, right?
Yeah.
Another just wild, amazing experience. And we, the show was going to air in March, and there was an HBO documentary coming out at the same time. And we said, hey, I guess maybe this is a good time to try and capture that attention and direct it towards really concrete things. And so that's why we launched We the Investors. And it really has been fantastic in terms of the number of people that have taken part, that have supported us, that have filed comment letters and signed petitions and such. And so, we're up to, our email list is now over 200,000, which is incredible. But, it really it started from almost nothing. It started from like 15,000 people in March of 2021 and has, just completely grown since then. And, I think it really has turned things on its head. And I can tell you, the brokers really hate us, and the wholesalers really hate us because we have at least started to change the narrative of who they represent. And we also have at the SEC, I think, a receptive audience that sees, those guys for who they are. And is trying to change markets.
That's great. Yeah. So before we go into the particular issues that you guys are advocating for, can you talk a little bit about how an individual investor actually can have a voice with the SEC versus just talking into the ether and yelling about Gary Gensler on the internet? Like, what can I do to, advocate for retail investors?
Yeah. I mean, I think that there are multiple ways that we've come up with, at least, that we think are very effective. And the first one is we run petitions. And, you might think, you sign your name, that doesn't do anything. It really does. It shockingly does. So the first thing that we did a petition against payment for order flow. And we got almost 72,000 people to sign that. That was our first real effort. And that blew minds at the SEC. No one had done something like that with this like esoteric market structure issue. And so every number on there counted. And we've done another petition that's a bit more wonky, and we've gotten over 40,000 signatures on that one, and that's fine. And again, but those numbers are way out of what the SEC is used to seeing. So it actually does. I think it really does make a difference. It's a really easy thing to do, and that's a place to start. The second thing you can do is you can call your member of Congress, especially if you are in a district that is represented by someone who, for example, might be taking money from Ken Griffin, Jeffrey
Money's
Riaz.
Everywhere. It's wild to see all their donations and contributions. It runs
everywhere.
Deep.
It's amazing, and it's amazing how many members of Congress, fall into that bucket. So, but you should call. You should let them know. And you should let them know that your vote, and a vote is more important than money when it adds up, unfortunately. But it does make a difference. And we do congressional campaigns from time to time as well. But the most effective thing you can do is to file a comment letter. And I know that that's not sexy, it's kind of boring, but it really does make a difference. As I was saying, I had this call with the SEC yesterday, and one of the first things they said to me was, well, we saw your comment letter was filed by 2,600 people. That, to them, that is an unprecedented number.
Real
for a
Americans
comment letter.
that are filing.
Exactly, and it means something. And so what we do is, when there's an issue that we think falls into sort of our purview and our expertise, we'll put together a comment letter. I'll often, work with people to write that. We will talk with experts around the industry. I want to make sure we're getting it right. I'll talk to people that disagree with how we feel about these things. It's very important to me that we're really on top of these things, because we do think we're having an influence on the rulemaking process, and I think it's important to get it right. But we'll put the comment letter up there, and you can download it and sign it and file it as is, or you can look at it and write your own. And that's frankly the most influence that you can have is with a comment letter where you write it. And you can pull parts of ours, but really get into why you care about this issue. Make it personal, and it does connect with people, because it is people who read these at the SEC, and by law they have to read every single one of them.
That's the most amazing thing. That by law they have to read every one. So your voice will be seen and heard. Now, obviously, from there it's then a matter of which direction it goes.
Yeah, absolutely. And not only do they have to read it, they have to consider it. Right? Like, it has to be part of the process for them to arrive at a final rule. And so, I've seen the direct effects of that. I mean, in the past, again, before most people were paying much attention to this, we were filing comment letters. I was doing that for years. And you see your comment letter cited in the final rule. You see the SEC acknowledge it. They talk about, this commenter said this, and we agreed, so we changed the rule. I've seen that happen many times. The SEC, whatever you think of them, generally is trying to get things right too. They're people, and they make mistakes, and lots of them, totally. For sure. No doubt about that. And we could talk plenty about the mistakes that they make, especially in crypto, which is just, man.
Never a dull moment over there.
Never a dull moment. But, I do think you can have an influence there, and that's the main thing that we try and do. When we say we're empowering individual investors, that's a big part of it.
It's amazing. So 200,000 people submitting comment letters, submitting petitions. And can you talk a little bit now about the kind of the 4 principles or the 5 principles of the areas that you guys are focused on?
Yeah. So the way I like to look at it is that when you're doing advocacy, a good way, at least my approach, is you set out these high-level principles, and that way they can guide you as things change and as new issues come. How do they fit within our main principles? The most important one is transparency. We want markets that are easy to understand, clear, and where investors can get all the information that they need. That's I'm a believer in markets.
I love them. Yeah, it's just,
I'm not a communist.
Yeah,
right?
No, totally. It's the American dream. It's why it was started, to allow every American to own a piece of the American economy as it grew. And
exactly,
totally.
right. And I think that markets are the best way that we have figured out to allocate resources. I don't think capitalism is very good, but I do think it's the best thing we figured out so far. And so, for that to work, you need transparency and you need informed investors. So that's just sort of over and above everything. That's our number one principle. The second one is what we call simplicity and fairness. And, I'm a big believer in simpler is better. Keep it simple. I think markets are complex systems. And when you get into systems theory and complexity theory and chaos theory and all of this, you can't sort of create something that is extremely complicated and expect that it's going to work how you think it will. And so we always try and say, what's the simplest solution? And what's the most fair solution rather than which one picks winners and losers or enriches certain parties to the detriment of others. The next one is best execution, that investors deserve best execution, not good enough execution, which is what they get today, but best execution. And this really goes into a big part of the campaigns that we've been working on lately, which is to educate investors who trade for free that there's no such thing. There's no such thing as something free on Wall Street. I assure you, I've been in it for a while, right? And the cost of free trading is inferior execution. And that cost is a rent that you're paying to your broker and the middlemen who execute the orders. And regulators have, for many, many years, said there's the duty of best execution. And we don't think that firms are adhering to that. The next one is what we call choice and control. Again, if you want it, as an investor, you should have complete control over how your orders are handled, how your accounts are managed, your relationship with the issuer, which is something that brokers like to sort of get in the middle of, and also how you hold your shares, because people in some parts of the market want to be confident that those shares are being held in their name, and that they are explicit. They're not some IOU on a broker's balance sheet. And then the last one is what we call better clearing and settlement. And this gets into lots of different issues that, again, are not very sexy, but really drive a lot in terms of markets. So, there are all sorts of proxy plumbing issues if you want to vote, for example, and retail investors don't vote generally, so that's a big problem. Retail investors should vote. They should be involved in the governance of the companies that they're investing in. But then when you vote, can you be sure that your vote is counted? Often not. There are huge problems with overvoting and votes that are just thrown out. And that's it gets into these proxy plumbing issues. And then there are problems with failures to deliver. And other issues that retail investors now care about. And again, these are areas that no one has really paid much attention to for many years. And now that people care, we're trying to help direct that energy into the reforms that we think are the most impactful.
That's great. So all of that sounds great, and I guess just to kind of simplify it for the audience, if I go and open up a Robinhood account and deposit $1,000 into it and go and buy 1,000 shares of Google with it, now I guess some of the issues that you touched on, I think, touch on the variety of different kind of the user flow here. So the price of Google on Robinhood, I think, touches on your data kind of component. Can you talk a little bit about when I'm buying 1,000 shares of Google from Robinhood, where does it start to go awry? Where are people taking pieces of that $1,000, and where does it go, I guess is the question.
Yeah, it's a great question, and you're right. Like from the very beginning, when you see the bid and the offer on Robinhood, you're not seeing the whole market, because Robinhood doesn't want to pay, because it costs a lot of money for you to see the whole market, and so you're seeing a feed that's discounted, and that's showing a part of the market. It's most of the time sufficient, but not all the time. But what happens really when you send that order, people think that, the order goes to the floor of a stock exchange, and there are a lot of people yelling at each other, right? And that's just not how it works anymore. Of course, that order goes to a data center in New Jersey. But that's if the order ever makes it to an exchange, and 90+% of the time it doesn't. Robinhood sells that order to firms like Citadel, Virtu, and a couple of others, but really like 70% of the market is owned by Citadel and Virtu. And that order goes to them. They pay Robinhood. Now, for a long time, they paid Robinhood a lot of money, a percentage of the spread. Robinhood, something like 70% of their revenue was from payment for order flow, which is this practice. And you can be sure that if they are paying that much for your order, there's a reason, right? They are making money from it. And that money doesn't come from thin air. It comes from the price that you get when you buy that stock. Now, they will say, what are you talking about, Dave? You're completely misrepresenting this. They get price improvement, right? You see the offer for Google, and you go to lift that offer, and guess what? Your price is slightly better than the offer you saw. Oh, that is so nice of them. They must be doing it out of charity, right? They're just such good people. They want to give you price improvement. But the problem is, first of all, there are a lot of other firms that would give you a price on Google. And most of them would probably give you a better price. But they aren't there contracted with Robinhood. They're there at the exchange trading. Hundreds of firms out there competing to make the best price in the market. And they never see your order. And so even though you got a slightly better price, what the whole practice does, this siphoning of orders to 2 firms or 3 firms, what it does is it makes it so that the only orders that get to the exchange are the ones nobody wants to trade against. Those are called toxic orders. And it's a bit complicated, but when all you have are toxic orders, it's really hard to make money as a market maker on an exchange. So what you do is, instead of quoting a tight market, you widen it out. You need to widen the spread to compensate for those orders. And on exchange, what happens is that spread is 30% wider than it otherwise would be, right? So if it is a 4-cent spread, it should be a 3-cent spread. It's a full penny wider just from this practice. And so then when Citadel or Virtu says, here is your 100th of a penny of price improvement, while they've destroyed the spread, they're making that difference. And you are screwed. And not only are you screwed in that individual transaction, it costs you money. It costs you money every time you trade. But this money that you've got in your pension plan for retirement, or in a mutual fund for retirement, those institutions are suffering and paying more than they otherwise would be. And this is all simply a wealth transfer to middlemen, rent-seeking middlemen. And so that's that concept that it's not just that you're not getting the best price possible because it's an anti-competitive system, this off-exchange trading payment for order flow system, but that it damages markets and causes them to be more fragile, more volatile. And there are studies that really back all of this up, that spreads are 30% wider. Extreme price movements are far more likely, and they're 54 basis points more extreme when they happen, that volatility of returns is higher as the level of internalization and off-exchange trading, this trading by Citadel and Virtu, as that increases. It damages markets. And so that's why, I know it's a long explanation, but that's why you won't find it anywhere else in the world.
Totally.
Right. It doesn't exist.
No other country has payment for order flow.
No, not in the UK, not in Canada, not in Australia. Europe just banned it. Singapore just banned it. This is not a controversial thing that I'm saying. Right. It's just controversial in the US, where the corruption is so staggering, the political corruption is so staggering, that you can't even make a logical, data-driven case like this, without being attacked personally and attacked politically. And as long as I've been in it, there has not been someone at the SEC willing to take on these very powerful firms. And it's also probably worth mentioning that the entire practice was popularized by Bernie Madoff.
Oh, yeah.
And you would have thought that would be enough.
Nope.
Right?
Nope.
You would think that would be enough to say, let's get rid of it. But it's not, because, other firms have stepped in as he so gracefully retreated.
How big is payment for order flow? How much money is getting siphoned away from retail investors on a quarterly, yearly basis? How big is this?
Billions of dollars. Billions of dollars, right? So, I could look up, I don't have 2022 off the top of my head, but 2021, it was almost $4 billion of explicit payment. So that's just the money flowing from the middlemen to the discount brokers. That does not include the damage that's caused to markets. So the SEC tried to estimate it in a recent proposal called the Order Competition Rule. Other studies that I've seen have tried to estimate what the damage is to markets. I think when you add it all up, it's somewhere on the order of around $10 billion a year of increased cost to trade for everyone in the market. Now that's not explicitly for retail, but that really does get to what are the increased costs for liquidity takers who are generally retail and institutional investors managing money on behalf of retail.
Mm-hmm. Got it. So every one of my orders there's a cut that Citadel is getting from it, and then I'm now on Robinhood. I have my shares of Google. Can you talk a little bit about this concept of failure to deliver and how shorting works? Because there's been a lot of talk around GameStop holders want to directly register their shares with the company. How does that work with me looking at my shares in Robinhood?
Yeah, well, this is a very controversial topic. So the way it should work is that Robinhood sends this order, and Citadel, Virtu, and a couple of these other firms, they have what's called a market making exemption. So normally when you sell a stock short, you have to go out and borrow those shares, right? Because you are selling stock to somebody. Right. Someone is buying for every transaction, every sell, there's a buy, right? And so when you go buy stock, you don't care who you're buying it from. Right. You want to know that when you buy it, you're going to get shares. Right. And so if you're buying from a short seller, well, if you're buying from a long seller, that's the easiest, right? They are selling shares, you're buying them. Boom, right. It moves over. Yeah, it's a DTCC ledger entry, and that's it. But if you're buying it from a short seller, that short seller at the beginning of the day needs to go out and they go to their prime broker and they say, oh, I want to be able to sell 1,000 shares of Google. Prime broker will say, you got it. I've located those shares for you. And so now that short seller has a reasonable expectation that they can deliver those shares. They sell those shares to you through Robinhood, right? And they go get those shares from their prime broker and deliver them to Robinhood's account at the DTCC. Now they have to pay interest on that position because they're borrowing. And if you own shares, you can lend them out and collect interest. But when you do that, you should know that you're lending them to a short seller who's betting against the company. And you can think about it, right? Markets work on supply and demand, and that's how you arrive at a price for a stock. There is a certain amount of demand to buy that stock, and there are a certain number of shares available. When someone comes in and borrows shares to sell short, they're increasing the supply of shares artificially, and so everything else being held equal, that should depress the price, right? More supply brings the price down. Now, that's a big statement of, all else being equal, of course, because things never are. These are markets, and arbitrageurs are always trying to, figure out where pricing inefficiencies are. But when you have large amounts of the float being sold short, it definitely makes you think, hey, there could very well be something here that's actually impacting the price. And in fact, there's case law. I don't remember the levels, but there's this analysis by someone called Asquith, which when they looked at it and they said it's called a but-for price, which is to say that when there are high levels of short interest, it's accepted by the courts that the price should be higher, but for the high level of shorting. And so that's often cited in some of these lawsuits on short selling when they talk about both excessive levels of shorting, but what we often find, and I used to do a lot of analysis around this, is that high levels of short interest are also often accompanied by signs of market manipulation. And that's usually in the form of spoofing or layering, which you can find. It's hard, but you can find it using publicly available data, and we've developed ways of doing that. So anyway, this is a very long explanation again for talking about that's how the process should work when you sell short. But sometimes when you sell short, you don't deliver those shares, and that's called a failure to deliver. And a failure to deliver, it doesn't necessarily relate to shorting, but often does. And the other side of a failure to deliver is what's called a failure to receive. So Robinhood will tell you those shares are in your account, but if there was a failure to deliver, they don't technically have those shares. And that's a real problem, especially when you see stocks on the threshold list, the Reg Show threshold list for weeks and weeks at a time. That is indicative of a serious problem that a material percentage of the float has failed to be delivered day after day after day.
Fake shares that don't really exist anywhere, and it's like, what's happening here?
Yeah,
it's just a number on a screen going up.
Yeah, it's crazy. And so as you mentioned, the GameStop community saw this playing out, and they said, how can we get around that? And they found this system called DRS, for direct registration, and that's when you take the shares out of the DTCC and you put them into your name on the ledger of the company that you own at the transfer agent. And I think very much of this practice. I think it's great, and I think it's great because it gets back to sort of the essence of investing. I'm not, even though my career started in trading, in which I would hold positions for maybe a second. I'm not personally much of a trader. I'm an investor. And so when I open up a position, it's for long term. And I don't think I think the DRS approach is one where, that's for long term investors. And it means that you have direct contact with the issuer. It means when you vote your shares, you're voting your shares. And, one thing that, firms who will dismiss all of this talk around failures to deliver and all of that, one thing they can't answer for is if this is not a systemic problem, why are there billions of votes that are thrown out every single year by the tabulator because of overvoting and imbalances where brokers are holding more shares on the ledger than what are at the DTCC. There are serious systemic issues, like I said before, with proxy plumbing and voting and governance, and that's under a system in which retail investors hardly vote.
Right.
What if they were all voting?
That's how you change the world, right? You're voting at the
exactly.
The big board meetings, and I want to vote off a board member or vote for changing the company, and I can't even, people aren't even doing that right now.
No, they're not. And there are some great brokers out there, I think, that are focused on issues like this, that are focused on providing free trading, but without taking payment for order flow. There are brokers out there that are trying to encourage people to vote and to see what it means to be part of this governance process. And I think those kinds of approaches will definitely further expose and exacerbate some of these problems. And so, I think that, again, retail investors, the more they understand these issues, the more empowered they can be to control how their shares are being held and how much they want to be involved. And the problem with this overvoting is that you will never know. You don't know if your shares are being held in street name, which is by your broker in their name. You will never know if your vote counted or not, or if it was thrown away. But if they're being held in your name, you will absolutely know. So it's not for everyone, and these are sort of deep market mechanics that not everyone cares about. But if you do care about how companies are being run and how they interact with the world and how they're governed, it doesn't. You don't have to care about ESG to care about the G, right. Which is how is this company operating, and are the executive taking too much money? Are the board members in the pocket of the CEO? Right. These are things you can care about, and you can lead efforts to change those companies.
That's great. Thank you for all of that. So I guess just to kind of recap the We the Investors and, for how people can get involved, can you talk a little bit about what's coming up? I know you mentioned that you were at the SEC. There's obviously a lot of excitement around that. What's coming up, and how can people find you?
Yeah. So, you can find us on Twitter under We the Investors, and you can find us at wetheinvestors.org. That's the best way. You can sign up for our mailing lists, and we will keep you up to date on everything going on. As soon as there's something to do, we'll let you know. It doesn't take anything. We're not asking for money or anything like that. Again, we think we're in a pretty unique position where we're advocating for rule changes that don't affect our commercial interests in any way, and not many people can say that. And this is, I think, the next 6 months are going to be probably the most intense from a market structure perspective. In December, the SEC put out 4 proposals, and they're the biggest changes to markets in 18 years since 2005. They are encountering fierce resistance from what I call the wholesaler industrial complex, the wholesalers, the brokers, and even some academics who are working with those parties. It's more important now than ever that individual investors' voices are part of this conversation. And we're going to be doing a visit to DC next month, and we're going to be meeting, with members of Congress, and we want to be able to tell them, hey, your constituents care about this. We're going to be meeting with people at the SEC. We've done a couple of public AMAs with Gary Gensler.
Saw that. It's great.
Yeah, pretty cool. We're going to keep trying to do those, and they're interested in continuing to do those. So, we ask our supporters questions. We don't really source them ourselves. We say, what do you want us to ask? And we take the questions, and we don't always ask them ourselves. We bring people into it. He should be interacting directly with individual investors, and that's what we're going to continue to do. So you can visit our website, you can hit us up on socials, and we're thrilled to see the support that we've had, and we're looking to continue to expand it. We know there are millions of investors out there, and we think most of them should care about these issues.
And thank you for being an advocate. I think to your point, there's been a missing kind of focus here and leaders. So I think this is a great initiative to kind of get behind. We're excited to be part of it. Thank you. I guess taking a little bit of a turn, tell us a little bit about Urvin. What's going on with that?
Yeah. So Urvin Finance is the company that we founded 2 years ago, almost exactly. And like I said, it kind of came out of the experiences we were having on social media, where we would see people like post charts, for example, and be like, what happened here? This is crazy. Right. And we'd be like, yes, that's crazy. That didn't actually happen. That's bad data. People don't like to hear that.
Right.
They call me like Dave Lauer, and that's fine. But sometimes it was something that happened, and sometimes it wasn't. And the problem was you couldn't trust the data, and people weren't all using the same source of data. But above and beyond that, what we really saw were these online communities coming together. And they loved to share information. They loved to better understand market mechanics, the companies that they were invested in. And we didn't really see a platform out there purpose-built for that. Reddit is great for some things, and Twitter is okay for some things. I don't even know, whatever you call it these days. But, there was nothing out there where, for example, you could do research on a company, create charts of the price, of earnings, of revenue, of different ratios and things over time, and then put those charts into a post and share that with people, and then have those people be able to have access to the exact same data you were using to bolster your arguments or counter them. And so that's where Urvin Finance came from, and that's what we've built. And we said people want the same kind of data that the professionals have, and they want it made simple and easy to use, and they want a platform where they can come together and talk with each other. And so that's what we've tried to build with Urvin Finance, where we have professional quality data and tools. We have a community where you can make posts and comment and share information. We've got the best news feed, the best price feed, the best full company financials. We've got real-time data, both equities, crypto, FX, and we're adding on educational material and resources with experts from the industry, from academia. We found a huge amount of support for our efforts to give better information to individual investors. So it's really been an amazing thing to be leading and to be a part of. And I think most importantly, we raised money from individual investors.
I love this. This is great. So tell us a little bit about how you got the company off the ground.
What we saw was there were so many people out there that wanted something like this, and we said, the only way this can really work is if they're going to be around for the long run, first of all, but if they're incentivized to really be engaged with us. And one way to have done that would have been to like do a Kickstarter.
Right.
But we didn't like that. We liked this new movement of investors who own equity in a company, who are their most passionate supporters, their best customers and users. That model that came about on Reddit, we're like, this is so cool. We should do this too. And so we raised money under Reg CF, Reg crowdfunding. And we raised almost $1.5 million from over 2,000 investors, and they get a stake in the company, actual shares, equity in the company, and that's just a great foundation to build a company generally, but certainly to build a social company in which you're trying to build a community.
That's amazing.
Yeah,
I love that. And I guess I know you guys just recently announced some new user milestones, right? How are you guys doing?
Yeah. Oh, I think we're getting close now to 20,000 users actually. Yeah, it's every week it's another milestone now. So we opened up for beta about 2 months ago. We started with that core user base, and invited a few off the list. So we had sort of 3,000, and our wait list has grown massively, and our user base has now grown commensurate with that. And we're seeing great activity on the platform. People are posting information, they're posting investment ideas, they're good ideas, some that I've come across that I wasn't even aware of. So, and I'm doing the same. So, it's been great to see this get started, and these things are slow, but it's fun. And I think every week now we're seeing a new milestone.
It's amazing. And where can people find Urvin?
Yeah, Urvin.finance. It's that easy. And if you want to sign up, you can sign up for the beta waitlist there, and we'll get you on pretty quick. We're now onboarding relatively quickly, and everything's free right now, which that's a good reason to sign up in beta. You get the best real-time data. It won't be free for too long from a real-time perspective, because that is super expensive to provide. Right. Like I was talking about earlier, most brokers, you'll get a discount feed, and you'll see just a small part of the market. We're giving our users the full market. That's not cheap. It's $3 per user per month, which is unreasonable, but that's a whole other issue in terms of market data cost and monopoly. But that being said, that's what we're getting, and you'll get the best fundamental data on companies, some great data viz that we've built, and more that's coming. And so I would say get on now while it's free, and then we'll try and we will figure out over time the right sort of subscription levels and features, but a basic subscription at most is going to be around $10 a month. We're really trying to keep this within reach of every retail investor, and that you can do that without having to go to like the advanced level, which even in that should be only around $35 a month.
Amazing. Anything else you want to share? Anything else you got on your mind? Yeah.
Crypto. What's going on with crypto?
Jeez, there was a big Grayscale ETF. The SEC's been going back and forth on that.
They settled with an NFT company.
Yeah.
That was pretty crazy.
The first of many, I feel. They say the SEC's on a 3 to 5 year delay with a lot of enforcement actions.
That sounds about right. Yeah.
I feel like this is just the first of many dominoes that are going to fall over the last 3 years of just pure insanity of selling.
So too.
How can NFTs not be, securities? And I think that's like the crux of a lot of this, where it's like you're selling these things, promising people that they're going to get benefits and all this other growth, and they're also helping fund companies. And
to me, that's the key, right? And that's why in this NFT case, if you look at the dissent from Commissioners Ueda and Peirce, they're like, we don't call baseball cards,
I saw that.
Securities.
Yeah.
And it's like, man, I really feel like that missed the point, right? Because Topps sells you baseball cards. That's a product. Right. That's revenue to them, right? Mm-hmm. If Topps were to go away, you still got your baseball card, right? And it's still got money, maybe even more money now that Topps has gone away, right? But an NFT, especially like the Impact, I think was the name of the settlement, the company that settled. There's another case, Dapper Labs, which is being sued.
NBA Top Shot, right?
Top Shot, right? Mm-hmm. So Dapper Labs goes away. First of all, your NFT actually goes away.
Right.
And the way that they were doing it was they were funding the company. This wasn't a product revenue thing. They were funding the company, and they're explicitly saying the value of this will increase as the value of the company increases. it really feels like they're taking the term NFT and using it to skirt securities laws in that situation.
Right. I never understood all this. It's like that's why Regulation CF exists, to be able to sell shares to your potential investors, and NFTs were just kind of like a cash grab of like, I don't want to do that. Like the SEC can't, like the regulations aren't there, but they're there. I mean, that's why they opened up Regulation N and CF so that anybody could easily raise money from friends and family without needing to be an accredited investor. So I think we'll see what happens with the next couple months.
I mean, I happen to be a fan of the securities laws, right?
Totally.
Like, I think that there's a reason they exist.
Exactly, right. I mean,
people have been hurt
30s,
over decades and decades and decades. We've refined them, and you might not like them, but
they protect people.
They do. They protect people, and they're important. And I'm not saying that they are perfect for this new technology and new world. I think we could use Congress to, their involvement in trying to legislate this intelligently. But until they do, I mean, I don't know what you think regulators are supposed to do. It's a pretty tough situation, especially when you look at how many people have lost how much money over the last, let's call it 5 years, since sort of the crypto really got into the popular imagination. And I say this as a really big proponent of crypto and a really early adopter. And unfortunately sold all my Bitcoin that I bought at $2.
Oh, no.
Yeah. I mean, Bitcoin goes from $2 to like 800, and you're like, what? And you don't
goes up to fucking 60.
You're
like,
so
oh man.
I don't like to talk about that. But I mean, I'm a big believer in crypto. Totally. I just think that we can do crypto in the right way to still protect people and still not run afoul of securities laws. I'd also I'll add this. I think a lot of people are going to be disappointed in the aftermath of this grayscale decision, because they seem to think a Bitcoin ETF is like imminent. And I think you're underestimating the ability of regulators to not act, because they got a lot of time to not approve a Bitcoin ETF.
Yeah. I saw that the Winklevoss put their first application in for this 10 years ago for the first ETF. And it's still not being traded.
I think you're still going to wait a long time. And regulators can easily come up with other ways to reject it. So we'll see. I've been wrong before.
Cool. Dave Lauer, thank you very much for joining us
on
thanks
another
for episode. Me. And so check out Urvin, check out We the Investors. Thank you for tuning in, and we'll see you again next time for another episode of the Bullish Studio Podcast.